presidential election is literally a few weeks away. Let's take some time now to have a look at the present position of the markets, and then let's do some historic work and look at past cycles, see if we can determine what the possible consequences are of different election outcomes to the markets as we go forward. Hello, my name is Bruce Frazier. Welcome to Power Charting. So the agenda is, let's look at the present position of the stock market, even though it is really in a holding pattern and has been since early September. Then let's take a look at the decennial pattern. It's an introduction to it, and look at some historic examples of prior decades. A big thank you to David Keller and the StockChartsTV team for including me in the wonderful panel on the presidential election. It was wonderful to meet with Tom McClellan, Jeffrey Hirsch, David Keller, and have a discussion about the presidential election. Do take some time to go to the YouTube channel and have a look at that. I think it was tremendous. So moving forward, let's look at the Nasdaq 100. I think it's the most important index of 2020 by far. And here we can see that once the COVID lows were reversed and the market turned up, it went into a beautiful trend channel that has been endured literally from April, May, all the way up through the end of August into September, and with a buying climax has become range bound. The market is range bound, it's waiting for the results of the election. You can see here that this is an exhaustion, a climactic exhaustion of major proportions with a huge throwover, and then an automatic reaction, resistance and support. The market has turned off of, the Nasdaq 100 has turned off this trend line and now is starting to show weakness and is listless. It's just hanging out, waiting for the election. It could very well be that there is more weakness to come. I think it's encouraging that volume is not expanding appreciably with the decline, which shows that there isn't active selling in the market at this time as there was back here in February, March in the large COVID decline. So we will keep a very close eye on that. This is a most remarkable point and figure chart. This is a 2% scaling log scale point and figure, one box method. It covers the entire accumulation structure of March to February. It's very well defined. This is the uptrend that we just looked at. Here's this big overthrow, very climactic. Big climaxes like this are important. And so we will keep a very close eye on this. But then notice that there has been a reaction off of that climax out of the channel, as was the case with the vertical chart we just looked at. Here you can see that there has been an attempt to rally. This chart was constructed on September 25th. Attempt to rally here. This is a secondary test of the climax. This is a tricky place because weakness could come back in that takes it down to the support area or possibly even lower. The count has been fulfilled here, and so this is the fuel in the tank. So a new tank needs to be filled either for accumulation for higher prices or potentially distribution for a turn down. So we will continue to watch. We think this is unfinished. Now, a most important chart, you've seen it before. I've added some more data here. This is the put-call ratio, SIBO options equity put-call ratio, and I want to give you a sense of the historic nature of the extreme of call buying that has taken place here in 2020. Now, here is the gold line is a 10-day moving average of the put call ratio. When it's way down here, there's a lot of call buying, bullish extreme speculation, which is contrary-wise bearish. So now look what's happened. We've had this tiny little move up into a secondary test of the buying climax in the S&P, just as we saw here in the Nasdaq 100. But look at how quickly sentiment turned back down again. Extreme call buying with a very tiny move rally upward, which shows that speculators are there ready to speculate on rising prices. When they are willing to jump in so quickly, move into the market, start speculating again, that means that the trend does not have legs. The other thing that's important about this is look at the history. This white line is a 35-day moving average of put calls. The gold line is 10-day. In both cases, you can see here that the ratio on a long-term basis is way below the levels, the extreme bullish levels of speculation going all the way back to 2017. This was a massive bullish climactic action here in the S&P. Also, this was a test, a very large testing area, and these areas did not produce the ratio of call buying that we've had here in the second half of 2020. Notice January, February, these were historic extremes. So with that, I think we must recognize that there is a lot of bullish speculation in the markets at this time, generally not a backdrop for a long sustained rising trend in the markets. A broadening formation in the Dow Jones Industrial Average is generally considered to be a large bearish structure. We've seen examples of where it's been a bullish structure back in 62 to 66. And here we can see that as the Dow Jones has rallied up into this zone right here, that it has stalled out at a lower high from the upthrusting high that was made back at the beginning of the year. And so here is a pause, and a large bearish bar has brought the Dow Jones Industrial Average back to the trend line. We watch closely to see if it comes back into the broadening structure. So let's keep an eye on that. For now, it's just flirting with and right at that area, and we will watch to see if it can come back in. And if so, it may have vulnerability back into the pattern. Here is a 60-minute chart of the Dow Jones Industrial Average. We've looked at this before. We can see that it's fallen out of its channel. This was the June buying climax high. It upthrusted that level here in September, and now it is in a trading range, literally waiting for the election. So this area right here is the one that we want to keep an eye on. Here is an interesting chart in Netflix. So Netflix has just turned down sharply. It is in the middle of the channel. We originally looked at this chart back in July, and we saw a buying climax, a sharp reversal, range-bound condition, resistance and support. And now we've had a secondary test here and here, both to lower highs, and a reversal back down towards support as of today, with a pretty stiff decline, about a 7% decline in Netflix. Let's just keep an eye on that and think about that chart in terms of the other large growth names in the space. All right, turning our attention to the topic for today, this is the Dow Jones 10-year decennial pattern. And actually, we use the Dow Jones because we have the most historic price data for the Dow Jones. What has taking place here is that every 10-year period, starting in the 0 year to the end of the 9th year, all those dates are summed together into this chart, and a pattern is created from the sum of that. It creates a seasonality pattern. Big thank you to Dimitri Speck for generously allowing me to use these charts. And you can see here that the things I want you to focus on here, and I'm going to show you historic examples so that you can draw your own conclusions about the value of doing this work. Here you can see that in the 0, 1, and 2 years tends to be the weakest years of the 10-year decennial pattern. Then starting in the 2 year, a base is produced generally, and an uptrend takes place that really oftentimes goes right through the end of the decade. The best year historically has been the 5th year. And then with a peak in the 7th year, climactic in nature, you get a sharp decline. This was the 87 crash as an example. And then the 8th and the 9th years are both robust, bullish, uptrending years, as was the case here for the Nasdaq and for the S&P and so on. So let's look at some historic examples. But first, I want to talk about, this is a chart you saw in the presidential election cycle special that I did with the StockChartsTV crew. And you can see here 3 periods, 1960, 80, and 2000. And of course, here we are at 2020. These are not every decennial period. These are the periods or the years ending in 0 that had a presidential election year. And so in 1960, John F. Kennedy defeats Richard Nixon. At the end of 1960, the incumbent party lost. Nixon was the vice president to Eisenhower, so the incumbent party did not keep the White House into a 3rd term. Reagan defeated Carter in 1980. Now, Carter was trying for a 2nd term and did not get it. And so the incumbent party loses. And this is a new decennial cycle in both cases. And then in 2000, Al Gore, Vice President Al Gore, was attempting to extend into a 3rd term the Clinton years. And so he was defeated by George W. Bush. And so the incumbent party lost in 2000. Now, notice this, think back on the decennial pattern. In the 2 year, so here's a downtrend in the 2nd year, there was a final low and then an uptrend begins. In the 2nd year of the Reagan administration, a low is put in, so we have a downtrending market. A low is put in and a new uptrend begins. In the 2000 period, big decline, and a very impressive base is built and a new uptrend begins. So in all 3 of these cases, bases are built and completed, starting new uptrends. Well, what did each one of these presidents have in common? Each president, starting with John F. Kennedy, Kennedy was somewhat of a trailblazer in that he had a 91% tax bracket that was the top tax bracket, if you can even imagine that. And he, after trying to turn around a very lackluster economy in 61, and having no success, decided that the thing to do was to lower taxes. So he lowered income taxes, corporate taxes, dividends, and capital gains. And as a result of that, kicked off a very important bull market in the 1960s, which we'll look at in a minute. In 1980, Reagan, starting in 80, campaigned for a large tax reduction on individuals and was succeeded, and ultimately was able to get tax rates down from over 50% down to a level of 28%. That kicked off a dramatic rally in the stock market. And so there was a and this is the whole part about elections have economic consequences, because what happens with taxes, and high taxes aren't necessarily bad for the stock market. They emphasize a different class of stock. And this is something I want to get into. And if we don't finish today, we're going to go into it next week, because literally we're marking time waiting for the election. So let's do some history. Let's do some history work and see if we can't figure out what these long-term trends are about. It takes time for an administration to get their tax policies through. Markets function and run based on how capital is treated in terms of tax rates. And so investors will adjust their strategies based on whether taxes are high or low. That's just the way it is. We need to think that way. We need to think strategically about that and just run our strategies, our tactics in our portfolios based on the environment on the ground, the tax structure that exists. And so it takes a long time for a presidential administration to enact a tax policy, and then for that tax policy to work through the economy. In the case of John F. Kennedy, he lowered taxes, a very unique idea, if you can imagine, from 91% down. And it was very helpful to the economy, which started to grow at a 5% rate of GDP. After that, it was very helpful to the real economy. And then also that lower tax rate really helped stocks. But the next four presidents that came along after Kennedy all started to find ways to raise taxes again. And so the 60s went quite well, but I'll show you the 70s was simply a hot mess. And so here we go. Let's keep going. I'm losing valuable time here. I could talk for hours on this. This is sort of our case study. This is the 1980s. So 1980 to 89. This is the Reagan years. You can see here the downward trending bear market. This was a pretty severe economic decline from 80 to 82. It was a severe recession. Kennedy, or in the years prior, in the 50s, there were 4 recessions in 11 years in the 50s preceding JFK's election. And so here, look what happened. In the 2-year, you start a new uptrend. Well, that's exactly what happened here. And the 80s was just almost a hand-in-glove relationship to the decennial pattern. Look at the buying climax in the 7th year, which occurs in the decennial, and then this is the huge crash, the 87 crash, which I remember quite well as a professional in the industry. And then the 8th and the 9th years were, again, continuation of beautiful uptrends. So now let's go back through history in the time that we have. And remember, if we don't get all this done today, we're going to come back to it next week, because this is the perfect thing to do when we're waiting for a very important election, which is a couple weeks away. So I hope that you'll stick with me through this. Here is the Dow Jones Industrial Average. Now, 30 to 42, I included the years into 42 because that was sort of the low point of World War II. And so in September of 29, the market peaked out and turned down. It went down 89% from high to low. Roosevelt was elected. Here you can see, here's the downward, the stride of the market in zeros 9, 1, 0, 1, and 2. Well, 89% decline. Who could expect that? But it was a very wicked bear market, and produced a depression in the economy. And then Roosevelt came in, closed the banks, consolidated the weak banks, and revalued gold to be able to increase the money supply. All of these had the effect of creating a dramatic rally into the 7th year of the decade. I had friends who were portfolio managers in 1937, and they told me amazing stories about their experiences. And there was this general relief in this uptrend. And then in the 7th year, a top was made. Look at how beautifully this worked. And so a top was made, and this decline was just a very severe decline in the markets, and really sort of extended the depression, so to speak, into the end of the decade. It certainly didn't help. And there was not a new uptrend in the market, but it just traded sideways, really distributionally into the 42 lows, which was really the depth of the bad news of World War II. And from then on, the market started to improve because it could see that we were going to win World War II and come out of this. So this 1930 to 39 period in 42 is just fantastically interesting. Okay, so here's 40 to 49. Now, here is a decline. Here we can see this is into the 42 lows, and then in the 2nd year, an important low is made, uptrend into 1946. The peak came a year before this peak was expected, and then a big trading range occurred into the end of the decade. But again, from the 2nd year through the 6th year, with the 5th year being the biggest and strongest, that's exactly what happened in the 40 to 49 period. A really fascinating case study. So you can see there's variation. Here are the Eisenhower years. Eisenhower's elected in 52, and here there's a general uptrend in the early 50s, not a downtrend. An important low is made in 53, and then of course a beautiful uptrend follows in 54, 55. This period here really followed the decennial with an important peak here and then a very sharp decline into the end of 57. And then look how beautifully this uptrend took place into the end of the decade. So worked quite well in the 2nd half. So these important areas do happen. This is why we need to be Wyckoff and tape readers to be able to follow sort of the essence of the trends and the bases, the lows and the highs. Look at this beautiful base in here in the 53. Okay, so now we're into 60 to 69. Keep in mind, this is the John F. Kennedy period. And so you can see the 62 low. We actually did a case study on the broadening formation that existed here, but look at 2nd year, important low, then a test, and then a rally into the 6th year. The reaction came in the 6th year, not the 7th year, and then we had an important run up into the 9th year. Here was the peak, came a little early, and then turned down into 1970. So here again, there's a good family resemblance in the decennial pattern of the 1960s, but keep in mind that this was a period of tremendous economic growth, 5% GDP growth, really a great period for the real economy through the 60s and into 1970. Well, the 1970s was simply a hot mess. And so from 70 to 79, you had a giant trading range. And this decline was one of the worst declines that we'd had going back to the 1929 period on an inflation adjusted basis, because inflation was so exceptionally high in the 70s. And so on an inflation adjusted basis, the stock market lost a tremendous amount of value. Also keep in mind that this was the Watergate period where Nixon, who was reelected here, ended up dealing with the Watergate scandal that ultimately he resigned his presidency because of it. And so the 70s was a very difficult period, but something happened here in 76, 77, and that was the beginning of a growth stock boom in small cap Nasdaq stocks. And so taxes were quite high through the 70s. And so there was an important trend upward in small cap growth that you could not see in these blue chip names, which is the S&P large cap. And we'll talk more about that in a minute. So now we're looking at 2000 to 2009. We looked at, well, I guess we haven't looked at the 1990s. Maybe we can do that next week because we are running out of time. But look at the decline that was occurred in the years 0 to 2. Important base. This is really a classic, beautiful base here that produced a rally through the period that the Decennial is working well here. A high is made here, as was the case in the 7th year, and then an important break. Well, this is the great recessionary decline. Important base made here, and then a rally occurs in the 9th year, which starts the epic bull run. So this is a very interesting period where the Decennial worked in the down years, it worked in the up years, and then we had a variation on a theme after the 07-08 peak. And this is a very interesting distributional top. This is the end of the dot-com era. Here is a very interesting top. And this is the an important top that very well defined the bear market that was coming later. And so with that, let's look here at the Nasdaq comp. This is interesting. This is what we'll finish on for today. And then we'll go into some other themes with Decennials next week. But this is looking at the Nasdaq composite back in 2000. This is the descent. This is the end of the dot-com boom. Very important decline. Look at the 77% decline in the Nasdaq Composite Index after the top is put in the 0, 1, and 2 years of the new decade. Wow. So the 0, 1s, and 2 years are very important for us to focus on. Now, we have an uptrend occurring, as was the case in the decennial pattern, right in, look at this clock in, right into the 7th year. But this NASDAQ composite, which does go up, doesn't go up anywhere near as fast as the blue chip and the value stocks go up through the middle of the decade. So we're going to look at that more next time. And with that, I'm going to say so long, have a great week, and see you next week.